What's going on, my friends? Is it 5 o'clock yet? Almost. Have to turn this Sprite into a margarita, my friends. Maybe not today. I don't know. We'll see. Okay, let's take a look here. Hottest question. Number one thing everyone's asking about this right here. This program, CalHFA, the California Housing Finance Agency's Dream for All. It's a shared appreciation loan program. Here's the handbook. Now, a couple things. If you want this handbook, I can send you a copy. Piece of Keiko. I'll actually put a link in the description on the YouTube video here. We're live on Facebook, Twitter, YouTube, LinkedIn. So you have to go to the YouTube to get the description and all the links. I'll also give you a link to look at interest rates and stuff like that. So you can kind of have the whole shebang here. But I'm just going to go through this with you because, this is something that sounds really good. It does. And actually, it is pretty awesome. It's pretty awesome. There's a few drawbacks that are important to note. The first one being that most people probably aren't going to get this. There's a limited number of people. I've heard estimates between 1,000 and 3,000, and it will depend. Between 1,000 and 3,000 families will actually be able to get this. And because of that, it's limited. That's an important thing to understand. It is limited. It's not like a lot of the other programs that CalHFA, we call it CalHFA instead of CalHFA. CalHFA has other programs that are more permanent. So for those programs, they're around and they'll be around. So you don't have to be discouraged. If you don't get this one, there might be another one. This one is really, really good because the 20% thing and no payment. So essentially they give you 20%. So I'll give you a Reader's Digest and then we'll get into the details. But basically, we'll give you 20%. Need a minimum 680 credit score. Okay, it's a conventional loan, so you got to qualify for conventional, meet conventional guidelines. And you can get 20% towards your down payment. There's a few other things we're going to go through the detail, but that's essentially what it is. The 20% can go towards your down payment or closing costs, either one, and or both. And you can buy a house using this. Now, the drawbacks are there's essentially no TBD approvals. So you have to know the guidelines. TBD means you submit it for underwriting before you have a house that you found yet. That doesn't exist for this. So whoever it is that you're getting the loan through, getting the program through, it needs to know what they're doing. And they need to read this. The reason why I want to supply it is because if you want to read it yourself, make sure you fit the criteria. It's not a bad idea, especially if you're using some out-of-state lender or something like that, which I don't recommend. Check the guidelines yourself. Check it out. It's all right here, and it's not complicated. You have to be in contract in order to lock the loan and reserve the funds. Particularly reserve the funds is the key thing there, meaning that like when you get pre-approved for this program, they don't just go, okay, well, you qualify for 500,000. So we're going to set aside 100,000 for you. And you tell us when you get a home and your 100 grand will be here. That's not how it works. As you get in contract, then you're able to request reserve of the funds. So you can't reserve the funds until you're in contract. So in other words, you need a listing agent to say yes before you actually know if you can get it. That's the catch-20. That's the chicken and the egg, hardest part about it. Escrow may take a little bit longer on something like this. We do a lot of 15, 14, 17-day escrows. That ain't happening here. I think 30 days is probably your best bet. Could go a little longer. Maybe plan on longer. Make sure you won't be putting yourself in a bad situation if it takes 45 days. Make sure you don't have a seller that's adamant about selling by a certain time, or there's something that's very, very important there. Just want to protect yourself contractually if you know this may take a second. It's also new. And this type of program, when it's brand new, it's going to be kind of like a mad rush, like a gold rush. And then when the gold's gone, it's gone. So it's just going to be absolute feast and then famine. All right, let's go through this. Yeah, I'm going to get out my maca. And there is, of course, a nice little table of contents. There's a little summary. All right. And the nice thing about this form too is there's built-in links that you can click on. These are built-in hyperlinks to this PDF. So I'm going to send you a link that'll take you to this PDF, but each one of these has a hyperlink to some of the things that are going to be in there. So program is for first-time home buyers. Okay, we're going to define that in just a second. What is a first-time home buyer? It's not what you think it is all the time. And it's for owner-occupied property. Okay, so owner-occupied property, first-time home buyers. Those are the first two things. Okay, each borrower must be a first-time home buyer. Just covered that. And they'll define that in a second. You have to be either a citizen or other national of the United States, or a quote-unquote qualified alien as defined in this section code. You must meet the credit, income, loan requirements of CalHFA's first mortgage loan program, the CalHFA approved lender, CalHFA's master servicer, Lakeview Loan Servicing, and the mortgage insurer as applicable. So in other words, you have to qualify per CalHFA guidelines, obviously. Now, there is a homebuyer education that's required for this. I always try to figure out, like, where does the money come from? Why would they promote this? Why would they do this? Let me tell you something. There's no free lunch. The money comes from somewhere. Usually these programs have higher rates. This one doesn't really. When you look at the high balance, so if your loan is going to be above 726,200, that's the key number right there, 726,200, then your rates are going to be higher on this program. But the conforming balance rates for loans under that look pretty decent. So, and there'll be a link for that too that I'm going to put in the description. So you have all the links right there. What in the heck happened over here? This thing likes to change what I draw into whatever it wants. Okay, first-time homebuyer definition. Importante. To qualify for the shared appreciation loan, all borrowers, including co-borrowers, must reside in the home. So there's no non-occupying co-borrowers. At every loan that you do, you can be a non-occupying co-borrower, even investment property, but not this one. Everyone who is on the loan must reside in the home and must meet the definition of a first-time home buyer. Will you guys please tell us what that means? Oh, here it is. A first-time home buyer is defined as a borrower who has not had an ownership interest in any principal residence. So you may have bought an investment property yesterday. That was the first home you bought, or at least in the last 3 years. It's all past 3 years. If you bought an investment property yesterday, but in the past 3 years, you haven't had an ownership interest in a principal residence or resided in a home owned by a spouse in the last 3 years, you still qualify as a first-time home buyer. So a lot more people, I think, will fit that mold than may realize. No non-occupant co-signers or co-borrowers. Our borrowers must occupy the property within 60 days. That's normal stuff. Underwriting and compliance. So I'll give you the short version of this because basically, here's the deal. They give you the 20% silent second, right? You don't have to make a payment on that, but you do have to pay it back. You do have to pay it back if you refinance or if you pay off the loan. If you sell the property, if you pay off the loan, you win the lottery, whatever. Transfer title. So it's telling you all the stuff. Repayment of the principal has to be done in these situations. Now, you can refinance one time, rate and term, no cash out, and subordinate this silent second. So let's say you get in today and rates are 6.5%. And, a year and a half from now, rates are 3.5%. This program will still allow you to refinance that first mortgage, subordinate the second. In other words, keep that second in place as the second mortgage, get the new first mortgage, no cash out, just rate and term, and everything stays cool, but you can only do it once. You can only do it one time. My guess is in the next year, probably the best time. We'll see. We'll see if I'm right about that. Shared appreciation. So this is based upon, essentially, whether you fit in a certain income bracket or not. So for borrowers with incomes above the average for that area, and they give you the tools here. So this is what I'm saying. The links are right here. You can boom, check the tool here. Boom, check the income limit tool there. In San Diego, the limit is $211,000 per year. Household income in Riverside, just to the north of us here, $173,000. San Bernardino, $173,000. Los Angeles, $180,000. So, but that's all in there. So you can check these links. It'll provide that to you. And here, let me just do an example. Let me just show you. So this is when I say hyperlink, in case you don't know what that means, that this right here is lit up in blue and underlined, and you can click this and it will take you to the link. Oh, it opened it up in a different window on my other monitor. But anyway, it takes you to that window and it shows you all those things. So that's what I mean by hyperlink. So those hyperlinks are in, where is it? There it is, are in here, and you can just open them right there directly. Now, if you are above 80%, so you need to be 100% or less, but if you're above 80, then they're going to want 20% of the appreciation. Okay, makes sense. They're going to want 20%, or sorry, 20% down payment, and they're going to want 20% of the home appreciation. If you're under 80%, so if you're under that 80% average income for the area, based on that lookup tool, they'll still give you up to 20% down payment, but they're only going to want 15% of the appreciation. So essentially, they'll take less of the appreciation. Now, people have asked questions like, well, what if the home depreciates? What if you sell it for less? Well, then there's no appreciation to share. There's nothing to give them. So that's how that works. There's a couple examples on here too that are kind of rudimentary, but I'm not going to take the time at this moment to go through it. They show you the formula here. Here's the formula, how we look okay, so you take the current value of the home as determined by CalHFA. So they reserve the right to determine that. Interesting and important point. Minus the lesser of the original sales price or original appraised value of the property, multiplied by the shared appreciation percentage. So they just give you a quick rundown here. Okay, here's what it looks like. It makes sense. Like, how much has the home appreciated? You owe them 20% of that, or 15%, depending upon the bracket that you're in. It's not that complicated. It's actually pretty easy. I give a few examples on here. And then, okay, underwriting compliance, income limits. Income cannot exceed CalHFA income limits. There's another hyperlink, another place where you can kind of check and see, okay, hey, do we fit in here for my area of California? California is a big state. There's a lot of people who have the opportunity, millions of people have the opportunity to take advantage of this. And we said, maybe maximum 3,000, maybe 3,500 people are going to be able to take advantage of it. You can go and you can check here. Boom, here we go. And see if you fit for your area. Gives you a couple other things here. Let's see. Cover that already yet. Minimum credit score. So minimum credit score is going to be 680 for this. And it says, follow Dream for all conventional first mortgage guidelines for minimum credit. That's a link also that I'm going to put into the description where you can look at that. So I'm going to give you basically all the links that are important for looking at this. They also have important documents here like subordination of the deed. So if you go to do a refinance, you're going to need that subordination request submitted into them. If you do refinance one of these things, always do that like right away. Those things can take a while. And if you only do a 30-day lock or something on your refi, you may need to like get that moving. So make sure you do that. They give you copies of the notes and the loan disclosures right here in case you want to read them. Here it talks about the refinancing and subordination if you want to do that. And then there's an actual contact. Boom, right there, directly from horse's mouth. You want to go there, you can get information from these people here as well. And that gives you just kind of a basic rundown. It's essentially, it's for conventional loans. I should have mentioned this. This is for conventional. This is not allowed for FHA or VA or any of the other products that are offered by CalHFA. So it's just for this one product, about $350 million for this, dedicated to this. And that is going to be what is there. Okay. So we're live on all kinds of different platforms here. If you want to ask a question or give a shout, feel free to do so. And I'll do my best to answer your questions. But I want to get to that first. That's the point of this video, is to talk about this. Now I'm going to go into the more timely stuff. So if you're watching this 2 months from now, what I'm about to talk about doesn't mean anything, but hopefully that helps make sense. So you're going to get this from me. You're going to get this link to this guy where you can download this PDF if you'd like to. You'll also get the links to the rates and the program guidelines, all that stuff going to be right in there. And then I will also give you a link to So like, for example, here's the online version. So if you want to just look at the online version at the CalHFA website, you can do that too. Then I'll also give you a link to this to keep an eye on interest rates. All right. As you can see today, my rates right now, at least 0.25% below these, especially on the FHA VA side, more like 3/8, almost 0.5% lower. I just locked one. Let me pull a live lock. You guys want to see a live lock from today? Let's see here. This in here. So here's a live lock. This one also a condo, 5.78. So basically like 5.75. So a little more than 0.25% less than what it's showing on here for VA, 6.125. So actually it's closer to 3/8 less. And that's no points and no lender fees. So live lock right there. This just happened a few minutes ago. Some proof of pudding there for you. But yeah, so rates are in really good shape. Overall, right now, I mean, if we look at the mortgage bond market, it's been boring the past couple of days. That's good. Kind of want that. We had this huge gap up, did not work. Gap down the next day and just right back to support. I'm cool with that. Look, if we can just hang out here around support, you know what happens when stuff hangs out at support long enough? Yeah, it'll blast higher. And when it does, rates will go lower. So when these prices are going up, rates are going down. And when these prices are going down, rates are going up. Inverse relationship. Pretty simple stuff. But today, we're up 2 basis points. Or did we finish flat? Looks like we finished flat. Yeah, we finished flat today. Huh. So we finished flat. So absolutely no movement today. But I'll take it. Look, the candles look good. I'm happy with it. It is what it is. Rates staying right at this level is okay. Don't want rates to get any higher than where they are right here. That seems to cause a lot of pause. I think if you can be talking about rates in the 5s for a big segment of the population, FHA, VA, especially here in San Diego, that's good enough to keep the needle moving. We got a good number yesterday, pending home sales. Expectation was that was going to be a negative. Okay, that was the consensus, and we actually put up a positive number. So I consider that to be a good thing today. Jobless claims, pretty much right. I'd expect a little bit higher. Continuing was pretty much right where everyone expected to be. So nothing crazy going on there. GDP is expected at 2.6, a little lower than expectations, but the market took off today. So this is really the story right now in real estate, and what's going on is just simply not enough sellers. I mean, we just talked about a program to help bring more buyers to the table. It's honestly not what we need. It's not what we need. It's going to make things worse in this regard. Programs like that will bring more buyers to the table, which means there will be more offers on properties, but it doesn't mean there'll be more properties. It doesn't incentivize more people to sell, really. So, in fact, not at all. People might say, oh, well, there's lots of buyers out there. Maybe we should think about selling, but that person only wants to sell for top dollar. So it will cause prices to go up. Very, very likely over the next few months, especially in California, we might see prices go up just because of this program. Doesn't need to be another reason. If you bring a whole bunch of buyers into a market where there's already more than enough buyers, you're probably going to see prices go up. So new listings continue to fall, according to Realtor.com, down 20% year over year. Dang. But people keep telling me on YouTube that there's going to be all these home sellers and the prices are going to get crushed. I know they keep telling you that. That's one of the reasons why I keep talking about things like this, the truth, reality. You do need a lot of sellers in order to crash your market. What we have right now is very few sellers. It's kind of a perfect storm. I mean, if you were to just draw up, like if you were to say, hey, what's the best situation if you're able to buy a home? Like, what's the absolute best scenario from an investment standpoint? The best scenario is you buy a home when there aren't very many buyers willing to buy. So let's go back to when rates really peaked, last year, let's call it October, when buyers were the most scared. That's the best time to buy. Yes, your rate would have been higher, but guess what? You probably already be ready to refinance or close to it. So you buy when the price is low and then you refinance when the rate is low. That's kind of the ideal situation. Hard to achieve. something that right now I think can be done. It can be done. We're still seeing, people, sellers who are in the market to actually sell their homes. They're ready to go. They're moving off somewhere else. They're doing whatever, relocating. They're ready to take an offer. The thing is, they're just getting so many offers that they have to kind of be greedy about it. I mean, multiple times now in recent days, we've seen sellers go, we're going to wait. We're going to do another open house and see if we get any more offers. They already have like 7 offers. What are you doing? Just testing the market. They know they're in control. And so there you go. Now, if you take those 7 offers and you add now there's 3 or 4 more offers because the California Dream for All, listen, a listing agent doesn't have to disclose that it's a DPA program. They can just tell you, hey, I've got an offer for this, 20% down. You're going to have to beat that. So in other words, a lot of these Dream for All offers will probably be used against the buyer who's going to actually get their offer accepted. I think it's going to be hard to get your offer accepted, Dream for All. I really am going to try to get one done. So if you want to do that program, I'm your guy. I will do everything I can to try to make it happen. I just think it's going to be tough. I think it's going to be tough. I'd say I think in markets like some of the smaller cap markets in California where the market is a little bit slower, there aren't as many offers. I think that's where most of these deals are going to get done. And I think the CalHFA people will like it because they'll be smaller loans. People who are buying houses for $300,000 or $400,000, like detached homes, and they won't have to be putting up these massive numbers per household. So they'll be able to serve more people with it, spread the risk out amongst more units, and ultimately probably show better numbers to whoever the financiers are for this or whoever's allocating capital for this to try to get it to move forward and stick around beyond this initial capital allocation. I could be wrong about that, but that's just my guess. It'll be in the slower markets where people get to really take advantage of this because you have a listing there and they don't have an offer yet. So you come in and you say, well, hey, I got this, California Dream for All. And they go, hey, that's great. Our sellers want to do a 45-day escrow. Oh, okay. Perfect. Let's get hitched. Like, I think that's probably more likely what's going to happen. But this is really, truly, this is the story of it all right here, is sellers just kind of like, not really, they're seller. If people own real estate right now, they're just like, I'm good. Maybe we'll sell some other time. Maybe when rates drop. A lot of people waiting for rates drop to buy. You're going to be paying a higher price. I promise you that. The one bad thing about waiting for rates to drop to purchase is that you're going to have a lot more competition. You're going to pay a higher price, and you don't really have any upside. That's the thing I don't like about it. Like, okay, well, I got the rate I want. I got 3%. You paid $100,000 more for the house, though. And now it can't really get better for you. If you buy a house today at 6.5% on a conventional loan or 5.75% on a VA loan, guess what? That can still get a lot better for you. Those rates can go down quite a bit. That payment can get lopped off quite a bit. There's room for improvement, and you paid a lower price. So not only did you get a better price on the house, but you also have upside in your scenario if rates drop. And if rates go up, then you'll be glad you got locked in, right? So that's where I think the market is right now, just sort of prime for the right buyers. It's getting competitive, though. I'm telling you, it's getting very competitive. Not all listings are competitive, but a lot of them are. So prepare yourself appropriately for that in this market. Okay. What's up, Rob? Late? Never, my friend. I want to say what's up to my buddy, Rob. Okay. Here's what we're going to do. We're going to do this right now. It is about that time for me to get back to some folks, finish a couple things up, take some calls. You can hit me up via email, call me, text me. That's if you want a loan quote. You don't need to pull your credit for that. If you don't like to pay lender fees, if you want wholesale interest rates, I got you. I'll be here for you. Give me a shout. Have a great night.